What's up everybody, Tom here with another video. Today we'll be talking about the latest stock market news, along with our technical analysis thoughts on the S&P 500, Nasdaq, volatility index, and of course, the US dollar. The Federal Reserve FOMC statement is now known to the markets. So what did the markets think of this statement? We'll be taking a look at that and more in this video. It seems to have been a bit of a fizzer. Stay tuned. So before we get started with the technical analysis, let's have a quick listen to what Jerome Powell had to say about the Federal Reserve's current statement and current policies in the markets. We'll also break down some of the key things that I think are worthwhile talking about from this statement. I'll see you in just a minute.
The recovery has progressed more quickly than generally expected, and forecasts from FOMC participants for economic growth this year have been revised up since our June summary of economic projections. Even so, overall activity remains well below its level before the pandemic, and the path ahead remains highly uncertain. With regard to interest rates, we now indicate that we expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time.
Okay, so really the Fed was pretty much reiterating a lot of what was said during the Jackson Hole Summit speech. Obviously, that seems to have been the more important speech, and this particular event was a little bit of a fizzer. But I think there's one key important thing to probably catch or take out of this statement. Obviously, we have long-term support in the market that continues, and the Fed are basically putting a put in the market. Nothing changes. They're still looking at that 2% average inflation target. And of course, they want to add jobs to the US economy, provide stability, and be as accommodative as possible. Again, same rhetoric that we've seen for quite a while. What I think is interesting though is the Fed's new dot plot. And that is when the FOMC members project that rates are actually going to go up. And usually, I guess the market wasn't expecting quite a long time. In fact, some projections in the market were upwards of 8 years before we actually saw an increase in potential interest rates. Now, obviously, things like growth stocks are very susceptible to interest rates both ways. The lower the interest rate, the better the growth stock's going to perform. The higher the interest rate, the worse the growth stock's going to perform. So when we look at a chart like this Fed's new dot plot, and we see there's a bit of dissentiment in terms of when the expectation of the rates are going up, we have a couple of committee members thinking it should go up a little bit earlier. That's interesting. But on top of that, they've given us some guidance that low interest rates are expected until 2023, when they expect the economy to be picking up and for them to be able to actually rate hike. And at this point, that is earlier than the market was expecting. And we saw that really in the results. When we have a look at the futures, we obviously did have the Nasdaq down a little bit. Let's have a look now at the screener and see what happened. So was it the main tech stocks that certainly fell off? It was. So all of the big growth stocks did not like this result. Obviously, the other sectors in the S&P 500 did like this result. They liked the idea, specifically banks did okay, and the energy sector did well, but that was a different story. So if this continues, we may see a result in, of course, treasury notes. Let's have a look at 10-year yields. Now, 10-year yields did spike a little bit. We saw it go up to 0.7. It's been on the increase now since pretty much August. And really, whenever we see 10-year yields increasing, that's not necessarily a great thing for the Nasdaq. There's some correlation between 10-year yields and, of course, what's going on in the Nasdaq. The lower these yields are, the better it is for the growth stocks. Overall, I'd be pretty optimistic if I was a bull in the markets right now. Obviously, the Fed have come out and again reiterated that they're going to support the markets. They have reiterated that they're going to use further tools if necessary if the markets go down. And of course, that will be to do with duration on asset purchases. So there's quite a lot going on there. And I think that's probably an easy summary just to go over the basics of what did happen. A couple of other interesting things that happened yesterday. We had incredibly low volumes through the market. So the volume was actually very, very low. And even though we saw a sell-off in tech, the volume and general trading was not as high as you would usually expect during such a big news event. Obviously, people are trying to figure out what exactly they want to do in the future. From a technical perspective on the VIX, we did see a spike in the VIX. It obviously did go up slightly. For any long buy VIX holders that bought into the event, they obviously may have done well there. And it did move up. It hit the 20 and the 50 exponential moving averages and found some resistance. We'll have to see what's going to happen, of course, tonight. I will be doing a live stream pre-market, so make sure you check that out. And if you think live streams would interest you, make sure to subscribe and, of course, hit that alert button, as we do quite a few of those over the last couple of weeks and months. Dollar index, more of the same really, but of course it's that buy the rumor, sell the fact, or in this case, buy the rumor, sell the news. So everyone was of course calling a very short dollar, and we're really stuck within two key zones. We talked about the 92 and the 93.80 a lot of times this week. Here it is on a monthly, and this shows why our top-down approach is really important. If we broke through the bottom range here of the 92, where do we think it would go to next? It's got a high chance of going down to the 89, because that was the bit that it filled during the 2017 into 18 period. We had previous resistance acting as support, and there would have been a massive gap fill, and that could still be open. So setting long-term positions here in terms of alerts could always be worthwhile. When we dial it in though, and we go down to a daily, it becomes pretty clear that we're now seeing a little bit of dollar strength coming in. We've got two rejection candles here based on the previous rejection as well. And if we get a new high, especially through these points, I think it's a very likely event that we would hit that 93.80 and see dollar strength. Now, you would usually expect dollar strength when you see a little bit of a spike in bonds as well, and of course a sell-off in the markets. But at this stage, we don't have a clear technical signal. All we know is that it's rejecting these points. It's rejected them after, of course, Powell's speech. And at this point, we have very clear bullish sentiment if it comes through and breaks past this 93.45 to 93.50 zone. Another key indicator being copper. Copper is still relatively strong. It's holding, of course, that resistance period. We have not seen it break out of the high up here. I think that if the Fed was to push the market through last night, and we did see, of course, a big move in the S&P 500 and it broke through that double bottom top, then we would have probably seen copper break out as well. At this point, copper's still stuck. And we continue to set alerts for 3.09 and between 2.95. And of course, there's a channel range right now on copper in terms of economic health. Over to the markets, what's happening on the S&P 500? Well, the S&P 500 rejected that 3420 and it came down a little bit. That was the top of course, the range that we're trading in at the moment. We're still stuck between daily closes underneath this 20 exponential moving average, the red line, and the 50 exponential moving average, the blue line. So it'll be interesting if the market sells off back into this line and allows dip buyers to get back in. On the right-hand side here, we have, of course, the Nasdaq. That took a bigger, further sell-off. Now, we have an engulfing candle here, and during this kind of crisis, we've seen, of course, growth stocks very susceptible to sentiment each way. So we saw a sell-off across quite a few big stocks last night, and that means that we could further see selling into potentially even the 11,000. Now, we've spoken about this. We've spoken about this quite a lot on the channel. If it broke past this resistance, remember, confirmation is key. It would have most likely sent it up to the 12,200 level. Now that we rejected and we got through all these moving averages again to the sell side, we could see further selling into the support of course, the 11,000 level. Now, that would be very interesting for, of course, dip buyers. We're right in the middle of the zone. So usually with channels, which is now pretty much a confirmed channel, as we've got one touch, two touches, and we're in the middle, we could get a point where it now sells off back into the support, finds support there, and then, of course, bounces up. Or we may get it going further down, breaking through this support, and of course, then allowing the opportunity for the really big, nice dip buy back on that weekly 20 moving average. Let's hope that that is one of the options. If you're a dip buyer, which I know a lot of people are on this channel, then that will be very, very key. If we go out to the weekly, we'll also see this is a decent rejection here in terms of candle. So if we get below this low, it pretty much straight away will signal back into the 20 moving average, hopefully back into that 10.5 level. and I would expect Wall Street to be picking up the Nasdaq heavily at that zone. I don't think anything Powell said in particular is negative really for the markets over the long term. Remember, we're in a corrective phase of the markets right now, and that corrective phase can certainly push it back down into these levels where you will see most likely further dip buying support. Before we look further at the S&P 500, let's have a talk about gold and Bitcoin. So gold really did fizzle last night. We saw it break out a little bit before, of course, the speech. Then we saw it have a shooting star candle followed by a bunch of wicks. Now, this really is good if you're a buyer as well, because now if we get past that 1970 long, because of the wicks, because of the rejections off this level, that will be incredibly bullish intent by the market. So 1970 would certainly be worthwhile setting alerts for, having a look at, and then of course making your own decisions. We might see something like this, a break long, come back and test, back into the 1990 highs. Now, if we continue to see that dollar strength, it will affect this, but long-term gold is looking relatively bullish, especially after, of course, Powell's comments. Over on the right-hand side here, we have Bitcoin, very strong resistance breaks. We spoke about this earlier in the week. We really like this particular trade up to the 11,200 level. As is usual, it goes very close to the point, 11,100, and then of course it starts to sell off a little bit. Bitcoin had a massive, beautiful base on it. If you haven't watched that, make sure to go and check out our previous videos, as there was a lot to learn, of course, about what Bitcoin was showing us on the daily into the 4-hour and all of the technical structures that it was showing us. Bitcoin for now has hit kind of that first level. Notice how it was previous support wicks, we acted as resistance. Really, that 11,200 to 11,100 zone was the zone, and we've rejected that slightly. So if we continue to see dollar strength through the next 24 to 48 hours, that may put pressure on, of course, Bitcoin, but overall, Bitcoin and gold still remain long, at least in the way that we see it, based on Powell's speech. Let's now look a little bit closer at the S&P 500. So the S&P 500 rejected that 34.25 zone. Previous resistance here on the left-hand side acted as resistance again. We saw, of course, Powell's speech slightly disappoint in the tech sector specifically, and then it is now broken through these moving averages, and they're all coiling incredibly closely together. Now, we'd expect probably further selling down here, and at least for the market to get back down to this point. So we'll draw that up right now and have a look at the markets. We've obviously got this 33.80 zone, 33.76. We're trading a little bit higher in the futures right now at the 33.89. And this point here, we would probably see some buying support. And then, of course, the hope is that it would go down to the 33.20 again, and for further buyers to potentially come in and a break low of that point. Because of the channel nature of this market, you would expect it to, of course, go the exact same distance. So we would expect this distance that was the pre-distance of the market to happen again, pushing us back down into the 3,200 zone. So Powell's comments obviously did not help this corrective phase of the market. They were not enough to really be a buy the rumor and buy the fact. It was more buy the rumor, sell the fact in this case, for now anyway. It still remains that if we break to a new high, it's an incredibly bullish signal that 34.25 has cemented itself as a key resistance area. And if we continue to go low in this particular channel here, we expect it to probably go back down to the 33.20, buying support to be there. And of course, a breakthrough of that will expose that 3,200 level. Look, we hope everyone did well. Obviously, it's another lesson to be learned about possibly waiting for confirmation in the markets if you're a technical analyst. It's really tough to trade Powell's comments and, of course, the Fed in general. Oftentimes, the market will do different things to what you expect. And in this case, it was really the same stuff from the FOMC, but, of course, with a little bit of a tinge of maybe we're going to raise rates a little bit earlier than you think, Mr. Market. If you enjoyed this video, please subscribe and of course hit that alert button, and we hope to see you at the live stream 10 p.m. AEST. I'll put it up on the channel a little bit later. Thanks very much. See you soon. Good luck.